Hello students and hello everyone. This is Teacher Angel and welcome back to our accounting online video lessons. For today, our lesson is all about accounting policies, estimates, and errors. So what is the scope of PAS 8? So PAS 8 prescribes the criteria for selecting, applying, and changing accounting policies, and the accounting and disclosure of changes in accounting policies, changes in accounting estimates, and correction of prior period errors. Basically, there are three main topics in PAS 8. First is the change in the accounting policy, which refers to change in the measurement basis. Second, we have the change in accounting estimate, which includes the changes in realization or incurrence of expected inflow or outflow of economic benefits from assets, or it could also be from the liabilities. And we have correction of prior period error, which refer to intentional or unintentional misapplication of facts and mathematical mistakes. So we'll go first to the change in accounting policy. First is we recall the lesson in basic accounting for the definition of accounting policies. So these are the specific principles, basis, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. So these are the rules that we have to follow so that we will be able to prepare the financial statements according to a certain standard, and it can be comparable with that of the other financial statements prepared by other companies across the globe. That's why we follow a certain standard uniform so that it will be easy for us to make comparisons and for easier understanding of the financial statements and easier interpretation and analysis, because the standards that are being used are applied to one company to another company. Accounting policies are also the relevant PFRSs adopted by an entity in preparing and presenting its financial statements. So the Philippine Financial Reporting Standards are the standards and interpretations adopted by the Financial Reporting Standards Council, and this comprise the following: the Philippine Financial Reporting Standards, the PFRS itself, the Philippine Accounting Standards or the PAS, and the interpretations. So in the application of the accounting policies, we have this hierarchy. So what should come first? What should be followed first in terms of the application and also in the interpretation? So una natong i-consider in the reporting standards ng application. First is we have to check if there are available PFRS regarding that transaction. So if there is a PFRS for that transaction, whether that is a PAS, PFRS, or an interpretations, that would be adopted or followed first. If wala, if dili siya available, then we have to use our judgment. And in making this judgment, we have to consider the following. The management has to consider the following: the requirements in other PFRS dealing with similar transactions. We would also consider the conceptual framework. Management may also consider the following: any pronouncement issued by other standard setting bodies and other accounting literatures and industry practices. So as you can see here, una gyud sa priority in terms of application and adoption would be the PFRS. So that include the PFRS itself, PAS, and the interpretation. If wala, then we will use the judgment. And in making the judgment, there should be consideration with the requirements of other PFRS and also the conceptual framework. If you can recall our lesson in the conceptual framework, diba, conceptual framework may be used if there's no available PFRS. Then aside from that, we also have to consider other pronouncements from other standard setting bodies and other literatures and industry practices. So in the application of accounting policy, the entity shall select and apply the same accounting policies each period in order to achieve comparability of financial statements or to identify trends in the financial position, performance, and cash flows of the entity. So once selected, accounting policies must be applied consistently for similar transactions and events. So if i-adopt na nato na siya nga accounting policy, dapat maogin atong gamiton all throughout. An entity shall change an accounting policy only if the change is required by a PFRS or results to a more relevant and reliable information about an entity's financial position, performance, and cash flows. Therefore, dili gyud siya as in on a regular basis that you're going to change your accounting policy. So na ay requirement before you're allowed to do so. What are examples of changes in accounting policy? We have change from FIFO cost formula for inventories to average cost formula. So FIFO average cost formula is an accounting policy. So change from one policy to another. Change in the method of recognizing revenue from long-term construction contracts. Change to a new policy resulting from the requirement of a new PFRS. Change in financial reporting framework, such as from PFRS for SMEs to full PFRS. So PFRS for SME are the PFRS that are applied to small, medium enterprises. Then initial adoption of the revaluation model for property, plant, and equipment and intangible asset, because there are two ways on how you're going to measure your PPE. Subsequent measurement may be using cost model, or you can also use revaluation model. So if you're no longer using the cost model and you're going to change that to revaluation model, that's a change in accounting policy. Change from cost model to the fair value model of measuring investment property. So fair value model is also a way in measuring investment property aside from the cost model. Change in business model for classifying financial assets resulting to reclassification between financial asset categories. Then how do we report a change in accounting policy? So if there is a change in accounting policy, which is required by a standard or an interpretation, it shall be applied in accordance with the transitional provisions therein. So therefore, you have to follow what is being prescribed in the standards as a result of the change. So kung naay gisugo dito nga dapat buhaton, dapat i-apply first, dapat ninyong i-carry out before you change from one policy to another, then kinahanglan to siyang i-follow. So you have to take note first the transitional provisions. If the standard or interpretation contains no transitional provisions, so wala siya mga rules on the standard itself, or if an accounting policy is changed voluntarily, the change shall be applied retrospectively or retroactively. What do we mean by this retrospective or retroactive application? So when we say it's a retrospective application, it means that any resulting adjustment from the change in accounting policy shall be reported as an adjustment to the opening balance of the retained earnings. The amount of the adjustment is determined as of the beginning of the year of change. So what does this mean? You have to adjust the beginning balance of the retained earnings na as if the policy has always been used before. So imuha siyang i-retro. You have to go back and change the amounts, but only for the retained earnings, and also you have to adjust the corresponding asset or liability in relation to that. Kaya ana ra siya kutob. So kung naay change sa asset or sa liability, unya ang pares adto kay mga income statement accounts, ang income statement accounts nimo pulihan nimo siya og retained earnings nga account. So you have to adjust the opening balance. So the amount of the adjustment is determined as of the beginning of the year of change. If comparative information is presented, meaning there are several years that's presented, the FS of the prior period presented shall be restated to conform with the new accounting policy. So we have an illustration here. An entity has used the FIFO method of inventory evaluation since it began operations in 2020. The entity decided to change to the weighted average method for determining inventory cost at the beginning of 2021. So these are the values for FIFO and weighted average for December 31, 2020 and December 31, 2021. So the FIFO inventory beginning balance on January 2021, di ba? From ano man siya, FIFO to um, FIFO to weighted average. So, ang FIFO beginning inventory on January 1, 2021, of course, mo na siya tong ending pagka 2020, that's 1 million. And then, weighted average inventory on January 1 is 750. So, ano man ni siya, ma'am? Because the ending balance in the previous year would be the beginning balance in the following year. So, we're talking about January 1, 2021. So, ang ending balance pagka 2020, mao na siya ang beginning for 2021. So there's a difference by 250. So you have to decrease your beginning inventory for 2021. Remember 2021 ang year of change. So the adjustment would be debit to retained earnings 250,000 and credit inventory January 1 250,000. Okay? So the computation of the cost of goods sold for 2021 would show the beginning inventory of 750,000 kanina ang gamiton katong weighted and ending inventory of 1,200,000. So kanina imuhang i-follow, which is based na sa weighted average to conform with the weighted average method. The statement of changes in equity for the year ended December 31, 2021 would show the effect of the change of 250,000 net of tax as a deduction from the beginning balance of retained earnings. So, ang beginning na tong retained earnings mo reflect na tong adjustment as if the 750,000 was really the valuation pagka 2020 December 31. Now, let's go to the change in accounting estimate. So change in accounting estimate is a normal recurring correction or adjustment of an asset or liability which is the natural result of the use of an estimate. So since in the preparation of the financial statements, there will always be a chance nga mag-estimate gyud ta. Like for example, when we estimate the bad debts for the month, when we estimate the number of years para magamit ang ato ang asset. So mag-involve nag-estimate. We also estimate the contingent assets, liabilities, ang amount of provisions. Those will involve estimate. Even the planning of how much we are going to produce for a certain month or certain day, how much food are we going to cook or prepare in the cafeteria or in our restaurant, diba? It will involve estimates. So naagi na siya on a regular basis. So recurring, balik-balik na gina siya, pwede gina siya nga magsigit ta og usab. Okay? But there are guidelines as to extent of the changes Diba? So, kinahanglan gyapon ta mo follow sa rules. Pero dili gani siya malikayan ang mag-estimate. An estimate may need revision if changes occurred regarding the circumstances on which the estimate was based or as a result of a new information, more experience, or subsequent development. So, if there are mga changes, so pwedeng mag-need gyud og adjustments or mag-need gyud og changes. By very nature, the revision of the estimate does not relate to prior periods and is not a correction of an error. So na naman tayo na record pag ni Agi, as is na to siya. Dili na to hilabtan. Kung naatay mga change in estimates, that is for the current period and in the future periods. Unlike the change in accounting policy that we have to change the opening balances of the retained earnings as if the change or the policy has always been applied, kaning accounting estimate, imuha ni siyang gamiton or imuha siyang i-apply in the current period and in the future periods. So, dili na mag-relate sa prior periods. When it is difficult to distinguish a change in accounting policy from a change in accounting estimate, the change is treated as a change in accounting estimate. So, kung maglibog kung unsa man ni siya, change in accounting policy ba ni siya or accounting estimate mga change, so you would treat it as a change in accounting estimate. As a result of the uncertainties in business activities, many items in financial statements cannot be measured with precision but can only be estimated. So estimates may be required for doubtful accounts, inventory obsolescence, useful life, and residual value of asset and warranty cost. So what are examples of accounting estimates? It could be change in depreciation or amortization methods. So example, from straight line to sum of the year's digits, or from sum of the year's digits to declining balance method, or from declining balance method to production method, from production method to straight line to some of the years to double declining balance to production, vice versa. So, pag mag-change ka sa imuhang depreciation methods, that is a change in accounting estimate. When there is a change in the estimated useful lives of the depreciable assets, so in the initial years, you have estimated that the life of your building would be 10 years, but since yung speed up man ng deterioration, so after year 3, you estimated nga 2 more years na lang siya. Or pwede sad nga maayo ang pagka-maintain instead of 10 years from the very time nga na nagamit ang building, so nahimo siyang 15 years. So kana siya, that's a change in estimate. Change in estimated residual values of depreciable assets. So, kani siya, dili man gyud ni siya 100% accurate. Kay pwede man nga ang residual value niya mo ubos in the future or pwede po mo saka yung value. Change in required allowances for impairment losses and uncollectible accounts. So, kani siya, estimate yun na siya. Changes in fair values, less cost to sell of non-current asset held for sale, and also biological asset. And also change in warranty costs, and change in estimated fair value of asset and liability. How do we report changes in accounting estimates? So the effect of a change in accounting estimate shall be recognized currently and prospectively by including it in the income or loss of the period of change if the change affects the period only, the period of change and future periods if the change affects both. So a change in accounting estimate shall not be accounted for by restating amounts reported in financial statements of the prior periods, unlike the retrospective application. So again, you're not going to restate amounts reported in the FS of prior periods because a change in accounting estimate should be handled currently and prospectively if necessary. And what is this prospective application or prospective recognition? So, prospective recognition of the effect of a change in accounting estimate means that the change is applied to transactions, other events, and conditions from the date of change in estimate. So, kung kanus-an na nag-start nga nausab imong estimate, ay hara ka magsugod og apply adto nga estimate. Dili na nimo hilabtan kung sa una 10 years tong iyahang useful life, so nag-depreciate na siya for 10 years adto, using 10 years ay as a base. So padayon na to siya, dili na nimo siya usbon. So karon na ka mag-start sa bag-o nimo nga useful life. Okay? Karon na ka magsugod. So kung useful life na lang from today until the end of its life is 6 years, so karon ka mag-start, i-divide nimo siya by 6 years. But the previous depreciations, dili na nimo siya hilabtan. Okay? As mentioned previously, di ba, na ay retrospective application. So, para klaro, okay, again, prospective application is the application of a new accounting policy to transactions after the date of the policy change with recognition of the effect of changes in accounting estimates in the current and future periods. The change is not applied to prior periods. On the other hand, if it is retrospective application, this means that you have to adjust the opening balance of each affected component of equity for the earliest prior period presented and the other comparative amounts disclosed for each prior period presented as if the new accounting policy had always been applied. The main difference between retrospective and prospective is that retrospective means looking backwards. Hence, we have to adjust the opening balance to present as if the new accounting policy had always been applied, while prospective means looking forward or into the future. That's why the application is now or currently and in the future periods. So we have an example for change in accounting estimate. A depreciable asset costing 500,000 is estimated to have a life of 5 years. At the beginning of the third year, so meaning duha na katuig kay at the beginning of the third year, ma'am, duha na katuig na siya nag-depreciate. So at the beginning of the third year, the original life is changed to 8 years. So, di ba, from 5 to 8. Pero remember nga, kaning 5 years, nakuhaan na ni siya pagka beginning of the third year. Nag-depreciate na siya for 2 years. So now, at the beginning of the third year, so assuming karon nga tuigan ng third year, 8 years na ang original life. So since na expired portion kay 2 years ago napalit ang item, di ba, or ang asset, so meaning 2 years na ang expired. So out of the 8 years, 2 years na ang nalapse. So pila na lang ang remaining life. Remaining life niya kay 6 years. The procedure is not to correct the past depreciation. Di ba pag niagi nag-depreciate na ta, pila to 500,000 divided by 5 years, so 100,000 a year ang iyahang depreciation. So therefore, 2 years nga depreciation niya is 200,000. Katong 200,000 nga accumulated depreciation, it will remain as 200,000 as is na to siya. Dili na nato siya usbon. So therefore, the carrying amount of the asset now is 500,000 minus 200,000 accumulated depreciation. Kanang carrying amount nga 300,000, mauna na siyang i-allocate nimo over 6 years. Ngano 6 years again, the revision or the revised date and revised life is 8 years. Original life is changed. Original life meaning from the start, from the beginning. 8 years siya. Pero na may 2 years nga nilabay, yun sa may pagkaiba mga 2 years ang nilabay, kay ang statement here at the beginning of the third year. So therefore, na 2 years nga nilapse. So i-divide nimo ang carrying amount of the asset based on the remaining life starting from year 3. or the third year. So therefore, 6 ang himuon nga useful life. 300,000 divided by 6 years. So therefore, for the third year, until the next years to come, nga magsigita og depreciate, that would be 50,000 depreciation kada tuig. So the entry for the third year is debit to depreciation, 50,000 and credit accumulated depreciation. So dili na tong tag 100,000 coming from the 500,000 divided by 5 years. So usbon sad na to ang depreciation kay nausab man ang estimate for the useful life. Then we have the third main area in the PAS 8. So we have the prior period errors. So what are prior period errors? These are omissions and misstatements in the financial statements for one or more periods arising from a failure to use, or it could be misuse of reliable information. It includes the effects of mathematical mistakes, mistakes in applying accounting policies, oversights or misinterpretation of facts, and fraud. Okay, so any errors may be intentional or unintentional. Gituyo man or dili, basta kay sayop siya. Like for example, ang dapat unta nga value sa imong assets kay 1 million, unya ang na-record kay 2 million. So sayop jud to siya, sayop ang 2 million. So we have to make corrections. So how do we treat prior period errors? Prior period errors shall be corrected retrospectively by adjusting the opening balance of retained earnings and affected assets and liabilities. So unlike the change in accounting estimate that you will treat the change currently and in the future, ang prior period errors is the same with the change in accounting policy wherein you have to apply it retrospectively. Kinahanglan gini mo i-correct siya ang mga balances in the prior periods, because if you would leave them as is, then the financial statements nga gigamit nato ron and in the future periods sayop sad kay sayop man ang mga beginning balances. If comparative statements are presented, the financial statements of the prior period shall be restated so as to reflect the retroactive application of the prior period errors as a retrospective restatement. And what do we mean by retrospective restatement? This is the correcting the recognition, measurement, and disclosure of amounts of elements of financial statements as if a prior period error had never occurred. So this is the summary of the entire standard. Okay, you have the three major areas or scope of PAS8. We have change in accounting policy, change in accounting estimate, and correction of prior period error. A change in accounting policy is a change in measurement basis, while a change in accounting estimate is a change in the realization of expected inflow or outflow of economic benefits from assets or liabilities, while correction of prior period error involves the intentional or unintentional misapplication of principles, misinterpretation of facts, and mathematical mistakes. How do we treat these change in accounting policies? That's based on transitional provisions. So kung naay gisulti sa bag-o nga policy, unsay dapat unang buhaton, unsay dapat i-change, unsay dapat i-adjust, i-follow to siya. Mao to siya ang transitional provision. Unsay gi-provide sa new standard. Kung wala or voluntary ang atong pag-change, then you have to treat it retrospectively. If B is impracticable, then prospective application. What would be the effect of any adjustments? So on the beginning balance of the retained earnings, that would be adjusted if accounted for retrospectively. For change in accounting estimate, you have to treat the change prospectively in the current period and in the future periods only. So in the profit or loss of the current period or current and future periods, if the change affects both, so ma-reflect siya karon o sa mga sunod nga period. If that's a correction of a prior period error, then the accounting treatment would be retrospective restatement because you have to restate the assets, the liabilities, and also the retained earnings. But if A is impracticable, then prospective application. So what will be the effect of the adjustment? It will affect the beginning balance of the retained earnings, the same with the change in accounting policy if accounted for retrospectively.
If you like this video, don't forget to click like, subscribe, and hit the notification bell to be updated with the latest video lessons. Thank you for watching.